Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Dr. Jeffrey Roach. Jeff, welcome back from the long holiday weekend. How was it? I know you did a little bit of traveling.
We did. We had a nice time. We did some snorkeling down in Florida, but the purpose of the Florida trip was to bring my parents back from Florida back to Charlotte, North Carolina. So I had a very long road trip taking the folks back, but we did sprinkle in some fun.
Very good. Well, it was family time for me too. I spent some time with the in-laws. Didn't do anything too exciting, but it was just nice to uh, to have a little bit more time to say goodbye to summer. So, and get the kids back to school. So hope all of you had a nice long weekend. Well, we're recording this the morning of September 2nd, so obviously with the holiday changing up the schedule a little bit. So we'll get this out by the end of the day. Tuesday. We'll start as we always do with a market recap, then review the weekly market commentary, which is about whether September will halt the rally. Based on the open this morning, it looks like it might. We'll have to see. It's just one open. Next, we'll talk about what I would say is probably the biggest market news over the weekend, and that's Friday after close. The tariffs under the International Emergency Economic Powers Act were ruled illegal by the federal court. That's going to go to the Supreme Court next. So we'll walk you through what that means and then close with a preview of the week ahead. And that's where, Jeff, we will talk about the jobs report. That is the big economic data point this week. So starting with the market recap, we were down on Monday, Friday, and up every day in between. So I just characterize this as a week with some ups and downs. We ended up flat pretty much. I think the big events of the week, Jeff, I guess you'd say two were economic and one was more market oriented. We had the Nvidia earnings news, and then we had the PCE inflation report, and we had GDP. So, do you think it's right that the market went nowhere last week, given those two important data points? And then maybe I can weigh in on Nvidia after you're done.
Yeah, well, I think the short answer is yes, because the GDP report was the second estimate, first published last month for the second quarter. And as more data comes in, more information on everything from, the sales of autos to the sales of software. The BEA does update those. We did have an upward revision for the second quarter, driven by software, a pretty strong contribution. And this is broader than just some of the AI conversations we've had over the last several months on structures, capital equipment, physical equipment that's related to the AI development story. This is about software. So your GDP reference an important one. That was an important data point. Did give us a little more clarity on the trajectory of things. And then of course we had inflation. I'll talk about that in just a second. But I think the short answer I said was yes. It was okay. Markets were roughly flat because the previous week was all about Jackson Hole. So I think markets are, rightfully responding to Chair Powell's nudge and hint about September 17th action. And markets responded accordingly. And then I think it's a little bit, if we don't get any shocks, that is a little bit ho hum until that Fed meeting the middle of the month of September. So expect fairly flattish activity unless we get some surprises. Certainly next week, we could get a surprise.
Yeah, I guess with the PCE inflation report, that of course being the Fed's favorite, being in line with expectations, that certainly matches up with a flat week. So I'd say on the economic front, if you want to make a case that the market should have been down, you would look at yields because Treasuries sold off a little bit last week. It wasn't really about the tariff situation. I think it was um, just more of a broader upward push on yields, partly driven by political uncertainty in France and the UK, frankly, that's pushed up global yields here today as well. So we've said it a bunch of times on this podcast and elsewhere that yields are so critically important. for so many reasons. So we'll keep watching that. In terms of Nvidia, I won't spend much time on earnings, but I'll just say that these numbers, even though the market sold off a little bit, these numbers were really good because, I mean, first of all, it's amazing that a company that size can grow 50% plus, right? That's something we've never seen before, which is amazing. Nvidia by itself pushed forward estimates for the S&P 500 up 0.2%. That is really remarkable. Typically, estimates fall during earnings season. They have risen during this one, and we've seen Nvidia have that much impact. Keep in mind that China's not in their numbers at all. So that really adds some gravy if they can figure out a way to sell the H20 or some other chip to China in a meaningful way. So again, it has nothing to do with why Nvidia is selling off. We don't think it's really other factors. Those numbers were excellent. So with that, let's keep going. Here's your bond. This is a 5-day look that I just priced this morning. So it does show the ag was up for the 5-day look, but we did see some pressure on the long end of the Treasury curve at the end of the week. I think that was probably the biggest reason why stocks sold off on Friday, given that the inflation numbers were, as I mentioned, in line. We also saw a little bit of upward pressure on commodities. I mean, Jeff, I know the leaders of China, Russia, and North Korea and India are all meeting as part of this Chinese summit. Certainly, I'd say no progress has been made on ending the Russia-Ukraine war. That's put a little bit of upward pressure on oil prices. And that, of course, feeds into inflation. Your thoughts there?
Yeah, we haven't seen a ton of risk coming out of energy prices. Clearly we had supply chain challenges that was providing an uncomfortable nudge up on inflation. Now I think it's about demand globally. I think one of the biggest risks, probably in addition to just energy side, but thinking about the global markets, can the global economies work together and move forward without the U.S.? And so important to remember, U.S. has the largest consumer base. And so that's one of the risks, I think. You think about our economy and some economies in Europe, uh, poised for a slowdown. Uh, that's adding a little bit of uncertainty when you see a number of major leaders meeting together, trying to coordinate outside of the U.S. But I think they all know each of those countries rely a ton on access to one of the biggest markets in the world, and that's here in the United States.
Yeah, we could do not just a whole podcast, we could do a whole day on the multipolar world and geopolitical implications that come with that. But we'll save that for another time. Any rate, we do, as you said, Jeff, have a little bit of a geopolitical premium built into oil prices still. We have a geopolitical risk premium built into gold too. Gold hit an all-time high over the weekend, and you see strong, nearly 5% gain over the last 5 days in the precious metals index. And this today we're seeing a little bit of a bounce in the dollar, but over the last 5 days it's been down a little bit, and the trend certainly this year has been down. So turning to the S&P 500 chart, what's a little bit new here is the strong breadth. We've been above these nice upward sloping moving average lines for a while, and we just hit an all-time high again last week. But the breadth in terms of the percentage of stocks above the 200-day moving average wasn't really all that strong, let's say, a month ago. Or a couple months ago, that has ticked up and actually exceeded 70%. That was a year-to-date high last week. So not only do we have a nice trend, nice momentum, but we have pretty good breadth. Now, of course, today's decline will change that a little bit, but the point here is that there's a pretty good technical foundation below this market, and then you also have some support levels here that aren't too far away. So we would think there's a good chance that the S&P 500 holds maybe 6,200. The I mean, the 20-day is above that, certainly. Actually, the 50-day is above that too. Call it 6,200 to 6,300. There's a lot of support. So we're certainly not getting too nervous here, even though we are seeing a meaningful sell-off today to start the week. So let's transition to the weekly market commentary. This is on LPL.com. Calm Before the Storm, written by Adam Turnquist. And the question really he's trying to ask in this commentary is if this rally can continue in September, because as I'm sure many of you know, maybe all of you know, the month of September is seasonally the weakest month of the year. On average, the S&P is down about 0.7%, and it's only up about 44% of the time. So not great. And actually, if you look at just the losses, you're down on average about 3 for the month when you're down. So difficult month. But what's interesting here is if you are in an uptrend, so if the S&P 500 is above the 200-day moving average, which, as I just showed you, it is, then September on average is up over 1%. And you're up 60% of the time plus. That is, pretty good month. Those stats would line up with just about any historically good month out of the 12. So we're not particularly worried about seasonality. We certainly continue to think this market needs a little bit of a dip, but this suggests that maybe we're not going to get as much of a dip as perhaps the media might have you believe. So I'll leave that there. The next section of the weekly is on earnings. So Adam did a really nice job there, making the point that not only are estimates for the S&P 500 rising, as I just mentioned, but the breadth is strong. So, the mega caps aren't doing all the work, right? If you have a high percentage of companies seeing positive earnings revisions, that really, again, puts a strong foundation. So we have a strong technical foundation, a strong earnings foundation underneath this market, which is certainly encouraging as we, potentially brace for a little bit more volatility. And then, we just wrapped up August, of course. Small caps were up 7%. So, Jeff, I want your economic perspective on this, because when people talk about small caps, they talk about the macro backdrop as being supportive or not supportive. But here you just look at this chart. The top chart is the absolute line, absolute price chart, and you have a golden cross. So the 50-day moving above the 200-day, typically a positive technical pattern. So we see that as bullish. Now we see small caps more of a short-term trade than a long-term, tactical or strategic overweight. But certainly this is encouraging, and we have been supporters of small caps as a short-term trade. The reason we're not really that excited longer term, one of the reasons anyway, is this relative strength chart. The S&P 6 is in a long-term downtrend or intermediate to long-term downtrend versus the S&P 5. So this tells you that small caps have some work to do to reverse this relative underperformance trend that we've seen. Well, we've seen it for a long time, but this chart highlights the last couple of years.
Yeah,
So,
yeah.
Jeff, thoughts on small caps from a
Well,
macro perspective?
yeah, well, a couple things. One is on that second chart you just highlighted. Remember, the S&P 500 as of now is heavily weighted toward, the Mag 7 as we've been talking about. But, before then, if you go back and, the 23, 24, perhaps Mag 7 is not as dramatic. Maybe we should do a S&P 600 versus the S&P 493. But I think the same story will emerge in terms of just the relative performance of small caps. One of the things that we do talk about in terms of small caps is interest rate sensitivity, and then of course trade uncertainty certainly is weighed on the small caps. But I think one of the things you could also say on the plus side would be if you see the momentum of a market, the momentum factor for those of our listeners that are in the know, that factor tends to hold, and you see that you see that momentum showing up in the small caps as well, and you don't want to get in front of that momentum trade. One of the things, just tying in these charts with the little title that we have for our WMC weekly market commentary. Plus, as we just introduced it a couple slides ago, can the September performance, can the market hold? One of the things that we want to just highlight is there are a few events that could provide some shock. It's not going to be a Fed rate decision. They've already told us at Jackson Hole that we'll see a cut later this month. But one thing that we don't know for sure is how things are going to shake out at the Board of Governors. So is Lisa Cook going to be fired for cause? Will she eventually just dig in her heels and try to fight back or resign? So some of the drama on the Board of Governors side of things, and that will filter through the rest of the Federal Open Market Committee, made up of Board of Governors and district presidents. So that's one thing that's a little bit um, could be a catalyst for a shakeup. Something to be mindful of.
Yeah, great point. The upward pressure on the long end of the curve late last week could have been related to some of the headlines around Lisa Cook, because the market's worry is that if rates go down too much, because President Trump, gets more control over the Board of Governors and the FOMC, then that could be inflationary. So that is absolutely something to watch. Great point, Jeff. If yields rise, that typically does put more pressure on small caps. So I haven't looked today, uh, but my guess is small caps are underperforming. Actually, I'll look right now. We haven't even opened. Well, we just opened. Um, the Russell 2000. Let's see. Well, the S&P 500 is down 1% as we're recording this. Russell 2000 down a little more, 1.2%. So there you go. Again, it's a very short uh, period of time. We just opened and we're just starting to get these quotes, but this is not the type of environment where you would expect small caps to do well if there's upward pressure on the yield curve, and then you have at the same time a falling market. All right, let's go talk tariffs now. Certainly, I mean, there wasn't any huge tariff news until Friday after the close, so it didn't really affect market action last week. But it has been this undercurrent, Jeff, for many months now. And clearly, the market shrugged it off to date. Now, maybe this latest news is a little tougher to shrug off. So the question we ask is kind of, where does the administration go from here? So this is a chart from Bloomberg. I mean, again, the news is uh, the IEEPA tariffs were ruled illegal by a federal court. That's going to be kicked up to or appealed to the Supreme Court. It's probably going to take several months for that ruling to come. And the courts issued a stay, right? So they can the Trump administration can keep these tariffs in place. I think what's going to get all the headlines and what maybe will be most interesting to people is this chart, right? We were at a 16% run rate on tariffs. Now we're at like 6.5, right? So more than chop these things in half. And so certainly, Jeff, investors who don't like tariffs, or investors who think, or market participants more broadly, if they don't like tariffs, or they think the market doesn't like tariffs, you would expect the market to celebrate this decision. But it's not. So what do you think the market is seeing here, if indeed the weakness today is at least in part related to this court case?
Boy, I think it's almost split between two main factions. One is the impact of tariffs are not going to be as dramatic for the end consumer, for the client. So if you're a business, you're thinking about, hey, can I keep running my business like I've been running my business the last several years? And so it's business as usual, trying to create a good experience, consumer experience, have them be loyal to the brand, all that stuff that business owners think about. And then I think this other faction is thinking, this is going to certainly weigh on consumers, and there's no way to get around the cost of tariffs, and they feel like, hey, they could pass those costs on to the consumer. I think there's such a still such an uncertainty. We don't, by the way, when you look at the aggregate econ data, you really don't see a dramatic and decisive impact from tariffs. There's still, you're seeing it maybe in some things like apparel, for example, but you're not seeing a dramatic pullback in real consumer spending because tariffs hitting importers. And then, of course, the other main conversation is how dramatic can businesses be to uh, apply for exemptions and exclusions, as well as reorder supply chains. So there's so many kind of subplots, as it were, going on right now.
Yeah, no doubt. There's a number of reasons. We wrote about this in a weekly market commentary about a month ago. A number of reasons why tariffs haven't really affected companies or the economy all that much, but some of those reasons are temporary, right? And so, despite this ruling, you're going to continue to see tariffs come on, the ones that have a different legal basis. You're going to continue to see tariffs come on, and that's the without IEEPA, right? You're just some of these are still coming. Now, what we talk about here on this next slide, and there's a lot here, and I'm going to just try to boil this down into one or two bumper stickers. And you've heard this from Treasury Secretary Besson. They have a backup plan. They can use different legal authority to put tariffs back on if the Supreme Court upholds the lower court decision and rules these tariffs illegal. So the Trump administration can ditch this IEEPA Act and switch to what appears to be either the this 338. There's, by the way, there's different opinions on where they're going to go, what the backup plan is. But they could go to this 338, and there's no time limit on that. That could be permanent tariffs. They could be just as high as they've been. But that hasn't been used since 1930. And there's legal questions about that. So we might end up going through the same kind of thing where the Trump administration puts tariffs on, then has to take them off. So that's possible. It's probably easy. But my opinion, based on what I've read, is that they're going to do a combination of temporary tariffs and then investigations that make those tariffs more permanent under a different legal authority. So I think you're going to see a combination of 122, which can last for 150 days, and then most likely 301, which is where they can say unfair trade practices. The U.S. trade rep has to do an investigation that takes several months. So then they can slap 301 tariffs on countries after they finish the investigation or after that 150 days runs out under Section 122. All right, so that's it. I'm not going to go any deeper into this because there's uncertainty, and I'm certainly not a legal trade expert. But Jeff, your thoughts on this?
Yeah.
Implications if we have these starts and stops, and oh my gosh, it's been hard for the Fed to make sense of inflation numbers to
Mm,
date. How are they going to make
mhm.
sense of the inflation numbers in
Yeah.
Q1 if we're coming on, off, on, off? It's a mess.
Yeah. Yeah. Well, interesting story. I was just with some clients of LPLs, and in the audience was a gentleman who runs a trade uh, kind of trade consultancy, works with importers all the time, and the 301 section where unfair foreign trade practices is the rationale. I tell you, hearing his stories, you definitely could see that has a legitimate place, I think, in policy, section 301. And then, of course, 338, I think one of the things that could go well in that is, since it hasn't been used for decades upon decades, there's just a lot more fuzziness in the application. Perhaps that might be a way to use it to the current administration's advantage. But certainly, a lot of really challenging things going on when you think about how other countries treat our exports. I'll leave it at that. So, excellent slide, Jeff. So, it's one of those things you just take a snapshot of this, and then you can dig deeper on your own time, not on this podcast, because there's a lot there.
Yeah, we'll put this into a blog on LPL.com, and people can spend more time with it and kind of digging in. Uh, Another element of this is, do tariffs get rebated? Right. So we might actually have $100 billion stimulus hitting the economy because that money is going to go back to companies that paid the tariffs. Of course, then it could be reversed later if the tariffs go back on, but uh, they'll at least have that money in the bank. And then in the end, you'll end up having less tariff impact, but you might get to the same kind of run rate. Probably a little lower, by the way. We've been talking about 15% as a landing spot. Maybe the landing spot now is 13, or maybe it's 12. We'll see. But it's probably going to be a little bit lower just because of all this legal uh, morass, we'll call it. I think that's a good word for it. So more to come there. We still are a few months away from a Supreme Court ruling, most likely. All right, week ahead. Thankfully, we're not going to have to spend too much time following the legality of tariffs under those different acts, Jeff. I think we can focus on the job market. We get the jobs report this week. That is a big one.
Yeah, that's right. So we do have a couple of other labor-related data. So JOLTS that you highlight there on the left side of the screen, as well as the ISM numbers. You have prices paid, but ISM gives us a snapshot of employment as well, and then claims that comes out every Thursday, ADP. But really, the topic, the hottest of all this week, will be the non-farm payroll report Friday morning, 8:30 Eastern, and a couple things to anticipate. Don't expect revisions probably to be at the same levels we saw last month. Do think that we are going to consistently hover below 100,000, which is kind of a healthy number you want to get for an economy that's chugging along. When you see job growth go closer to 50K, maybe even sub 50K on a consistent basis, that's definitely one of the strongest signs that consumer spending will start to slow as wage growth and income growth, job growth, et cetera, all slow. So here's why I expect a weaker than consensus number is the fact that last week's consumer conference data suggested that most consumers have reported, just self-reporting, saying jobs are a lot more hard to get, less plentiful than they were before. That does a great job in predicting the unemployment rates. In general, it suggests that the labor market is slowing down. Again, we talk about slowing, we're not saying cratering. So this is not necessarily an outright bearish view, but it's saying hey, we've been in this late cycle environment for quite a while. Now we're continuing to slow down, and that's going to eventually show up in consumer activity. So sub consensus, I think we're going to be closer to 50K than where consensus is, and I do think that we'll have a slight uptick in unemployment. One thing that could be somewhat of a positive, long-term positive, is that labor force participation rates seem to be recovering consistently. So just more people coming off the sidelines into the labor force, whether looking for work or actually hired and working. So that's the expectation for Friday morning.
I'm glad that you made a call on the job support, Jeff, because I do not want to do one. I have had a terrible time trying to predict that job support, even when trying to factor in comments from you and from others. It's a tough number to predict, but I agree with you that the general trend is a slowing labor market. That is clear, and the Fed has told us they see that as well. So thanks for that. We'll go ahead and wrap here. We're at the end of earnings season. So you'll get a couple of stragglers, but I think we're at 494 S&P 500 companies having reported. So I mean The good news is that the buyback window is open, so that can be supportive because now the companies have reported they can start buying back stock again. This is a record year for buyback announcements. 1.1 trillion, I think, is where we're tracking to. But the bad news is we don't have good news from earnings season as a catalyst. So this might be a logical place for the market to take a little bit of a breather because we're not going to have fundamental news. We're just going to focus on macro. And there, of course, as you just alluded to, Jeff, there's a little bit of anxiety around the job market and certainly anxiety around the Fed and inflation. So keep watching the macro here. That's really going to be the focus uh, in uh, in September until we reload for third quarter earnings season starting in mid-October, the month where bear markets go to die. So, but we got still September to get through. So again, hope all of you had a really nice long holiday weekend. Thanks for joining us on LPL Market Signals. Thank you, Jeff, for jumping in early, basically fresh out of the long drive back from Florida. Everybody have a wonderful week and take care. We'll see you next time.